today's video, I'm going to go over a profitability calculator that we use here at Team Koukun when we analyze deals, and especially when we send out deals to our clients on our hot deals list. Now, if you're not already on our hot deals list, that is exclusively for those of you who sign up for one of the free guides below. So I'll leave one of the links below. Once you sign up for those guides, you'll be given the option to sign up for our hot deals list, where we share a deal every week that we find that's currently for sale and that has some good investment potential. So this video is going to explain how the profit calculator works and just go into some of the numbers and the explanation of all the different parts that's involved. So let's dive right in. So what I have in front of me was the last hot deal that we sent out just last week. This was a property located on Lincoln Street in Welland. This property was listed for $580, and you can see this is the first portion of the profit calculator. So we start with our list price. This is not always the sale price, so it is something to consider. When we have some insight as to what we think the property will sell, we'll put an estimated purchase price, but sometimes that can be quite a bit off depending on how much competition there is on the property. So let's go back down here. So in this section, we have the down payment. Typically, that's 20% of your purchase price. So what we have here is 20%. I think this is still set up just to be 20% of the list price. So it may be a little bit more based on the purchase price. Land transfer tax is a bit of a complicated calculation to figure out, but this Excel has that already built in. So this calculates it based on this listing price. Legal fees, we estimate $2,500. That's, you know, your lawyer's fees, your title insurance, and the miscellaneous fees that come with purchasing a property. So all in all, at this listing price, the total investment needed would be about $126,000. And in this section, we put in the estimated purchase price of $600,000. The mortgage that you will be getting on this property would be about $480,000. Mortgage interest rate, we use the current variable rate, which is about 2.25%, maybe even a bit less. And then this is the total investment needed. Now, you can see some of the numbers are a little bit off. That's because we put in this estimated purchase price here. Sometimes what we'll do is actually put the estimated purchase price on this section. And then you can see here, then the numbers make a little bit more sense where the total investment here matches the total investment here. The reason why we change this up sometimes is if it's a property that needs major renovations and we have some insight as to what the property will be after the work is done, we'll typically put the purchase price on one side and we'll put the ARV or the after repair value on the other side. This particular property doesn't have any renovations needed, so it's just based on the estimated purchase price. So if we go down here, there's 2 apartments already. We estimated that it would bring in about $3,100 in monthly rent. This mortgage payment that you can see here, this is the mortgage payment for a $480,000 mortgage with a 2.5% interest rate, and we typically use a 30-year amortization. Property taxes, based on the listing, what they provide. Insurance is basically what we estimate based on what we've seen for duplexes, and utilities, again, the same, what we estimate based on what we see for duplexes. So based on these numbers, you can see that this property has an estimated monthly cash flow of $644, which is quite good. Now, keep in mind, this calculation doesn't include property management, maintenance and repairs, so those are real costs. It's sometimes tough to estimate, especially the maintenance and repair and the variable costs, so we typically leave it out of the calculation. The way we look at these kind of deals is if it has some cash flow, the cash flow is there to cover those miscellaneous costs. It's not true profit in your pocket, but it's sort of an insurance that covers you from paying those out of pocket. So that being said, let's go on to the bottom portion. So you can see here, this is a projection of what we estimate the property to do over the next 1, 3, 5, and 10 years. The cash flow is this amount. Again, this may or may not be the true cash flow, just because if part of it needs to get used for a furnace replacement or roof replacement or some capital expenditure on the property, this cash flow may be used up for those items. But here's just a rough idea of what it would be if there were no additional expenses. But when it comes to the true profit, it is in these 2 portions here, the mortgage paydown and the equity appreciation. So the mortgage paydown is a fixed value, we know it ahead of time based, this calculator automatically plops it in. So from year one, you're gonna have $12,000 of mortgage paydown, and that's just gonna increase over time. So you can see by year 5, 66,000 of mortgage paydown, and by year 10, 140,000 of mortgage paydown. You can see by year 10, your mortgage paydown is actually more than your initial investment. So that is an incredible amount of the mortgage just being paid off by the tenants, simply paying their rent every month. The equity appreciation is a bit more hard to know because you're essentially forecasting into the future what you think the property is going to be worth. What we use here at Team Koukun is 5%, and what we consider that to be a fairly conservative number. It's been significantly lower than what we've experienced over the last 5-10 years. But what we estimate is over the long term, and we're talking 10-20 years, 5% is quite a reasonable number that we think you should be able to achieve by holding on to real estate long term. And along the way, there may be some downturns, there may be some years where real estate is not in favor and that prices do come down. But over the long term, you should be able to get a 5% appreciation. This doesn't take into account inflation, so this is just a 5% appreciation. The true appreciation after inflation would probably be less based on these calculations. So that is based on a 600,000 purchase price, 30,000 in the first year, 165,000 by year 5, and close to 377,000 by year 10. You can see how even a 5% appreciation can become a significant number over any meaningful period of time. On to the bottom here, so the profit, this is just the sum of the top 3 numbers. So this is the profit from the property. And you know, if you want to be even more conservative, you can even remove the cash flow portion of the profit if you assume that all of the cash flow is just going to go straight to upkeep and keeping the property in a good condition. You can see it doesn't make a huge difference on the profit because the cash flow is only one component of profit, and that cash flow is just the fixed number on day 1. Say by year 3, rents go up, year 5, rents go up, and definitely by year 10, you should be seeing quite a bit higher in rents. The cash flow number can be something material at that point. But if we look at it without the cash flow, look at this. So total return on equity. Return on equity is your return based on this initial investment. So it calculates your profit as a percentage of this investment. So you can see in year 1, you have a 32% return on equity, and the compound return on equity is also the same. So this is your return on investment, so to speak. By year 3, you'll notice something interesting happening. So the total return on equity increases to 102%, but your compounded return on equity reduces to 26%. And I'll explain why in a bit. Year 5, the total return goes up to 177. Year 10, it goes up to almost 400%. So imagine that for every dollar invested in this deal in 10 years, you could be looking at getting $4 back. And when you're talking about investing over $100,000 and getting back close to $500,000, these are some life-changing numbers. It doesn't take too many of these properties to completely change your financial future. So let's take it a step back and let's look at why the compound return on equity is reducing. So it starts at 32%, goes down to 26, 22, and 17%. It is important to give you some context here. When you're starting out, you only have $100,000 in equity in the property, but as the years progress, the amount of equity you have in the deal, both through appreciation and mortgage paydown, is increasing. So your return as a percentage of that new amount in the deal is becoming less and less simply because you have more money. One of the greatest investors of all time, Warren Buffett, got to be one of the greatest investors by creating a compounded rate of return of over 20% over a period of 60 years. In the beginning, he was making close to 50%, and that dropped down to 20% as the numbers got larger because it is hard to continue to compound money at a very high rate over long periods of time. So with this property, it is natural that the compounded rate of return goes down to 17% over the 10 years, simply because you have less debt, you have more equity, and the returns you're getting become smaller as a percentage of the equity you have in the property. This is a very good problem to have, because it means you've made so much money in the property that it's not growing at the same rate. And if you want to continue to grow the money at that faster rate, what most investors do, what I've done personally, is to tap into the equity in the property, refinance it out, and redeploy it into another deal, hopefully with as good numbers as this deal, so that now the equity from the first deal is funding the second one, and they're both continuing to grow. It does come with some risks. You are taking leverage, you are taking debt on the property, but it is a way for you to continue to compound your equity in the deal. But that is a quick snapshot of this profitability calculator. Again, we send this out weekly to our investors on our hot deal list, and if you'd like to join it, click one of the links below to get our free guide. And once you sign up for the free guide, you will be redirected to a website where you can sign up for the hot deals list. We purposefully don't advertise this hot deal list because we really only want it to be sent to people who are really considering working with us, and this is a benefit for working with us. We'll send you deals, we'll run the numbers for you, and screen properties to find deals that look to be good investments. Hope you found this helpful. If you have any questions, feel free to comment below. Until next time, all the best.